Hi guys, and now we are at the end of statistics, at least for finance. I mean, I could keep on going teaching you statistics forever because it's so wonderful and it's so useful, at least for investment finance specifically, right? But we're going to restrict for financial modeling till return calculations, right? Because these are going to be very useful for you, specifically if you're going to use financial modeling for investment management. This is going to be very useful, right? Now we're going to look at risk adjusted return. So we know how to calculate returns. Now we know how to calculate risk, but what about the decision making matrix, right? So we're going to discuss about three basic calculation techniques. It's already presented in your slide, so which you can just read it through, but I'm going to directly jump into the calculation, right? So because that's what makes more sense, right? So the first is going to be coefficient of variation, right? Now it sounds very complicated, but all you're trying to do is you're trying to use the variation, right, divided by uh, the returns, right? So by the Sharpe ratio, right? Right. So the first is going to be coefficient of variation, right? Which, if you look at the formula, what you're trying to do is you're trying to calculate the ratio of standard deviation to the returns, right? So it's you're trying to calculate how much risk are you taking for 1% of return, right? So in a simple way, it's a little counterintuitive. Okay, so it might confuse a little bit, but as I said always, right, just do the calculation and it will be clearer, right? So we're going to first find the coefficient of variation. So I'm going to just keep it here, or let's try to keep it on the right side itself, so it will be much easier. Coefficient of variation, right? CV is what I'll call it. And CV is calculated as standard deviation divided by mean, right? So let's say standard deviation divided by the mean, right? So now this is obviously taken as a ratio, so it's not percentage, right? So 3.09. So what this actually tells us is, how much standard deviation am I taking for 1% of return. So that means for every percent of return that I'm generating out here, for example, 18%, right? So every percentage of return that I'm taking, I'm getting compensated. I mean, I'm taking three times the risk for 1% return, right? So it's a little counterintuitive because you're trying to, quantify standard deviation rather than the return. Because if you look at the next uh, formula, which is hugely used, is the Sharpe ratio, right? So Sharpe ratio will make more sense to you because it's intuitive. So what you're trying to instead do is, instead of calculating standard deviation over the return, you are saying returns over standard deviation, right? Because you're saying how much return am I getting for one standard deviation of risk. In coefficient of variation, you're saying how much standard deviation am I taking for 1%. So it's exactly opposite, right? But nevertheless, Sharpe ratio is calculated as the return, the average return, minus the risk-free rate. Because remember, if 18.4% is the return that you're generating, right, uh, entirely is not what you're compensated for is. Because if you say 6% is government bond returns, then that means the premium that you're getting to take the risk is about 18.4 minus 6%. So this is the risk premium that you're taking, right, by investing in Yes Bank, right? So Yes Bank is giving you 12.4% more than the government bonds, right? Because you would not try to calculate risk adjusted return only on 18. Then you are saying that there is no such thing as risk free in India, right? Which is not true, right? So let's say I take 6% as the risk free rate, divided now by the standard deviation, right? So again, this is also now used as a number, uh, as a ratio rather than actually a percentage. So 0.22. So the Sharpe ratio is not very nice, right? Because the standard deviation is too high. Again, remember, Sharpe ratio is based on mean and standard deviation, which again get affected by large fluctuations, right? So even though the returns look nice, 8.4%, it is getting affected more by these large fluctuations that have happened at recently. Instead, if you had selected standard deviation only for the particular places where the deviations are not happening, then the standard deviation would have been very different. For example, let me just show it to you quickly. So if I ignore the large fluctuation, right? So let's say we forget about the recent past, right? So standard deviation come to about 47%, which is still better than 56%, right? So your Sharpe ratio would be almost 0.26. So not much difference, but yes, uh, Sharpe ratio tends to get affected by large fluctuation, right? And yes bank, if you see, has been pretty volatile. So I mean, if you see out here minus 36%, then even the upside gets calculated as standard deviation, right? uh, Whether it's downside or upside, both are getting calculated as volatility, right? Now the best ratio to actually use is the MAR ratio, which is also called as the managed account report. Is now, instead of calculating basis standard deviation, what you're trying to do is you're trying to calculate basis drawdown, right? So again, the mean returns minus the 6% risk-free rate divided by the drawdown, right? So I suppose I had calculated drawdown, but I think it's gone. But let me just quickly bring that back to you. And instead of maximum, I'll have to use minimum, because remember for the chart we changed it to minus. So that's about 97.3, right? So now what we'll have to do is we'll have to use the absolute function to make it positive, the ratio, right? And the MAR is about 0.12, which is like saying that for every percentage of drawdown risk that I'm taking, I'm getting compensated 0.12 times, so which is pretty low, right? So the Sharpe is already bad, but the MAR is even worse, right? Because it captures the 97, the highest drawdown which took place recently. So that's how you calculate the risk adjusted return after knowing how to calculate uh, basic risk dispersion, right? So we've covered almost everything that we need majorly for financial modeling. As a financial analyst, this much of statistics is enough. Unless, of course, you are becoming a quantitative analyst, where this will not be enough, because you will have to go ahead and learn hypothesis testing, linear regression, all of that concepts. Hopefully, I would be able to teach you that in the specializations. But for now, for the basic core program, this is where we end with statistics. So I hope it was clear to you. Uh, Even though the calculations are not as important as the concepts, at least from the interview perspective, so you should know the challenges of all of these calculations rather than just know how to calculate it, because calculating is very simple. I mean, you really don't have to do such long methods to calculate. I mean, the functions are available, right? Standard deviation, sample. You just select the values and you'll find the answer, right? There you go, right? We didn't have to do such long calculation, right? Even the mean, you could just take the average calculation, right? Drawdown, obviously there's no formula for drawdown, but nobody will ask you how to calculate drawdown, right? But you need to know where drawdown is better than standard deviation, and how is MAR ratio better than Sharpe ratio, or what are the challenges of Sharpe ratio, right? How do you present data, uh, you know, returns versus drawdown, right? All of these concepts at the first principle level should be clear to you, right? So I hope that was clear, and I hope you are still motivated to do this program. Remember, financial modeling is a lifetime skill. So it's not just for you to enter the job. Even during the job, you will require it. Even in your personal finance, you will require it, right? And added to that, we spend a lot of time building our fundamentals, starting from basic Excel to financial mathematics all the way up to statistics, right? And the next basic fundamental, which obviously you might be tired with all the fundamental concepts, but it's going to be accounting, right? You cannot become a financial analyst without learning accounting. So I'll see you in the next part of this course, which is the part 2, and we will get into some bit of modeling as well as making a base in financial accounting. So I'll see you in the next lecture. Thank you for watching. Bye bye.